And we're live. Welcome to Benny and the Squirrel. Delighted to have with us this week Monsieur Louis Gave, CEO and founder of Gavekal Research and a bunch of other stuff he'll tell you about later. Louis, welcome to the show.
Thank you very much. Can I start off by saying how inadequate I feel because I've got no bookcase behind me. So I want to say before we get started, I want to say that I actually do read books.
You've actually written books. You've actually written books. That's the biggest flex of the lot.
You know what they say about Donald Trump, right? He's the only guy who's written more books than he's read. So maybe
strong start, Louis.
Maybe you could say the same. Maybe you could say the same about me. But I actually do have a bookcase. It's just not here in this room.
Perfect. Well, listen. I mean, I'm in a dangerous territory, really, Louis, because there are a lot of views that you publicly have, which I share intensely. The good news is that Ben doesn't agree with some of them, but for those with
this guy is so excited to get you on and beat me up a little bit.
We'll try.
For those of us that might have a negative dollar bias, should we start there, right?
Yeah.
The last 18 months really have felt, actually probably 15 months have felt pretty good, and pretty good for the types of assets that we have tended to like. Basically, things that hurt when you drop them on your foot, things that are outside of the US. Is there anything that you're sensing? And timestamp this: we're here on February the 12th after a pretty shaky day in global equity markets. Is there anything you're sensing this week that would change your thinking?
So I love starting with the dollar. I absolutely love starting with the dollar because I often say that, look, there's at the end of the day three prices that matter. It's the dollar, the US 10-year, and the oil price. And if you get the direction on these three broadly right, then everything sort of falls into place. Value versus growth, EM versus DM, financials versus tech, shapes of yield curves, like all these things sort of get directed by and large by those three prices. And of the three, I do think the US dollar is probably the most important. And so, you and I have been bears on the US dollar. So why have I been a bear on the US dollar? When I look at any asset class, I look at it through four prisms. First is the fundamentals. Now, when I look at the U.S. today on a fundamental basis, now you could say, well, the U.S. is the greatest country and it's got pocket aces and it's protected by two oceans. It's self-sufficient commodity-wise, et cetera, et cetera. But I think everybody knows that. Markets are, of course, made at the margin. And I think what you're seeing in the U.S. today is, frankly, pretty irresponsible fiscal policy. I would say a central bank that is allowing this fiscal policy to go really unchallenged, and a country that's running twin deficits of 12% of GDP, and at the same time spitting in the eye of every foreigner out there, which when you're running twin deficits of 12% of GDP, I think you need to be nice to foreigners. You shouldn't be slapping them around. So the fundamentals, I think, in the US don't look that great. Then I look at the momentum, and the momentum has been deteriorating. The third thing I look at is investor positioning. And when it comes to investor positioning, I genuinely believe that everybody and their dog is overweight US assets. The US is 70% of the world MSCI. So it's 22% of global GDP. So that there's a bit of massive skew towards US assets, partly because for the past decade, we've been told the US is the cleanest dirty shirt. It's the best looking horse in the glue factory. It's so on and so forth, that everything else was uninvestable, that the US was exceptional. So, I don't think these things change over 3 months. These things take 10 years to evolve. Then finally, you look at valuations, and I don't know when the last time was you were in the US. I spent a fair amount of time in the US, and the US feels very expensive relative to anywhere else in the world today. So on my four sort of prisms, the US dollar is expensive. And now I get to your point. The US dollar is unattractive today, whether it's momentum, whether it's valuations, whether it's fundamentals. Now, I do think, and to your point about the sell-off we're seeing in the market, I think one of the things underpinning the dollar in recent years was the idea that the most important thing in market was actually knowledge. And that all the knowledge, quote unquote, knowledge companies, and I wrote a lot about that back in 2005 in my first book, Our Brave New World, that knowledge companies were by and large in the United States. Now, what's been fascinating to me, you talked about today's sell-off, what's really taking it in the shorts today is precisely these type of knowledge companies. It's precise, it's the Oracles of this world, or the Moody's, or the FactSets, or the S&Ps. And it's all of a sudden the idea that, these things are worth 30, 40, 50 times earnings because they're able to monetize knowledge. All of a sudden, it's like, actually, knowledge is free. Forget it. Knowledge, thanks to AI, is going to be ubiquitous. And if you have knowledge, that's going to get undercut by Claude or by ChatGPT or by, DeepSeek or whoever else. The idea that you're going to be able to monetize knowledge is suddenly becoming massively undermined. And so in that respect, if this is the case, and right now that's what the equity markets are telling you, because when you look at the equity markets...
Can I pause you 1 second there, Louis?
Yeah, please.
And I'm going to let Ben ask his question because I know it's itching at the tip of his tongue. What if this is, Ben, you can ask the question about leverage, right? What if this is just the narrative?
So I agree with most of what you said, and I remember being a big dollar bear 20 years ago, and I think we're going to get there. I just feel as though we have one more leg. Like, when you think about the amount of our total debt outstanding is 350 trillion in the world, and about 2/3 of it is US dollar denominated debt. So you're talking about like, I don't know, $12 trillion of demand every year just for interest. And so you think about that, and you think about the deleveraging factors. I think everyone looked at last year as this, okay, we went down, and then the dollar went down again. And what I would say to that is a lot of money left the country to front run tariffs. I think a lot of money did. That was the move down into Liberation Day. And then the post, and I don't have the charts with me, but I can show you just in skew, ton of hedging. So now I think maybe what your argument is that the next level is the dangerous level, but on like a trend basis, we're just at the bottom of the channel. So we're still in the battle. I'm losing right now, but well, I
think where I thought you were going was that I love the ribbon that Louis wrapped around the market action of the last few weeks, right? This knowledge economy unwind. But what if we're just dealing with the deleveraging? Was my question then. And if this is
I was going to get to that.
Is if this is a classic deleveraging,
well, then the dollar should have gone up. To be honest, then the dollar should have gone up.
Bark, right? It's the dog that didn't bark.
It's the dollar should. If we are going through the deleveraging, the dollar should have gone up. Gold should have been smoked. Silver should have been smoked. Now you could tell me, well, last Friday it got smoked, etc. But look, unless you literally bought gold and silver 48 hours before they got smoked, you're still up on the year. And I look at the past few days. The past 48 hours to me have been fascinating because on Sunday you had this blowout win by Takaishi in Japan, which should have been yen bearish and JGB bearish. Like I expected to wake up on Monday morning and to see JGB yields up 25 basis points at the long end and the yen to be at 160. I really did. And today, and then you compound that with some stronger than expected jobs number. And of course you could say, the job numbers are bullshit. And excuse my French. I don't know if this is a PG show or not. You could
not.
Okay.
And I agree with you that it was BS.
Yeah. But so you could say, okay, the jobs numbers were BS, etc. So the reality is this week, everything should have happened for the yen to go down, and it went up, and it went up big. And so
they got an inverse triple yazoo because their stocks went up, the currency didn't fade, and the bonds found a bid, right? Yep. The JGBs found a bid, which is
so all this doesn't support the narrative to me of, oh my God, it's the great unwind, etc. Now, I also think that the big policy change that nobody's talking about, because this year it's all been about Greenland and Venezuela and Iran, and and the reality is the U.S. captures the U.S. president captures all the headlines all the time. But the most important development for me this year is you look at the past 50 trading sessions. The renminbi's gone up 45 out of the past 50 trading sessions.
I'm sorry, Ben, we're getting to this one a bit early.
That to me is the important shift. And so I look at everything that's unfolding. You have, on the one hand, a Korea that is saying, look, repatriate your money tax-free if you reinvest it here. If you invested abroad, we'll put up high capital gains taxes. But if you invested at home, no capital gains taxes. So all the money comes home. Kospi is up 25% or 27% year to date after a 75% year. Takaishi is probably looking at what Kospi is, what Korea just did, and said, "Ooh, I'll have me some of that. Why don't I do this?" That's like an open net. Like, I want the yen to go up, and I want money to come home. Hey, sell your stuff abroad. You got 3 months to sell your stuff abroad. No capital gains tax. Bring it home. After that, high capital gains tax for you abroad. No capital gains tax for you at home. And guess who else is going to do that? Everybody's looking at this Korea move, and then China. You're going to say, yeah, you know what? Let's do the same thing as well. So you're moving into a world where, are you a capital importer or a capital exporter? If you're a capital exporter, then the question becomes, do I want a strong currency? Yes or no? Because Korea just showed how easy it is to achieve it. And so Korea, and do I want a higher stock market? Yes or no? Like, Korea, again, just showed how easy it is to do it. If you're a capital exporter. Now, the reality is the U.S. is a massive capital importer. And the way the U.S. imported capital is through this rhetoric of, we control the world's knowledge. We're the number one knowledge economy. We're like, forget owning copper. Who wants that? Forget like buying stuff that if it drops on your foot, it hurts. What you want is bits in the computers and zeros and one. Now this is where it gets interesting. Is ChatGPT came out, and the US added 30 trillion in market cap in the following 3 years. They added one US GDP. The view was very much, oh my God, US is going to dominate AI, etc. Now all of a sudden we turn around, it's like, oh my God, AI is going to destroy all these businesses. Like, forget it. Like, Moody's is gone, S&P is gone, FactSet is gone, CBRE is gone. Like, anything linked to knowledge, poof, gone. And so you have it sort of undermines the very it undercuts the very premise under which people deployed capital in the U.S. Because why are you going to buy in the U.S.? You're going to buy GM? You're going to buy Ford? You're going to buy Caterpillar? Forget about it. So
all three of those have done quite well lately.
No, I know they've done. They've done because all the other stuff is doing terribly. So if I ran today a U.S. equity portfolio, I would be thinking, I definitely don't want to be in these businesses that are going to get crushed by AI. Forget all the knowledge stuff. That stuff is trading at 40 times earnings. It's now gone down to 25 times earnings. And by the way, not a single CEO has stepped in to buy back their shares. Instead, what's going to happen now is all these CEOs, if I'm the CEO of Oracle today, or I'm the CEO of FactSet or Moody's or any one of these guys, and I'm looking at my share price that's just been halved or more, or 2/3, I'm looking at it and saying, okay, I need to fire a third of my workforce or the market is going to get really pissed at me. So next thing I do, I fire a third of my workforce, and then these guys are going to sell their stock because they'll need to pay the mortgage. So I'm definitely not buying my stock because I know I'm about to fire a third of the guys who they themselves are going to start selling the stock. So now here's the question is, again, the starting point is the U.S. starts with a current account twin deficits, current account plus budget deficit of 12% of GDP. Therefore, for the U.S. dollar to stay at even keel, it needs to attract foreign capital. What's the selling proposition today of the U.S. to a foreign investor, to a Korean, to a Japanese, knowing that the tax treatment is very likely to go against them in the very near future? I think there's no attractive proposition today for a foreigner in the U.S. The market is more expensive. The currency is too high. The policy making is completely off the charts and completely unpredictable. And politically, domestically, if I'm now a Dutch pension fund or a Swedish pension fund, the U.S. is no longer ESG. It's like I'm getting letters from my pension fund constituents saying, hey, why are you invested in the U.S.? Donald Trump's a terrible person. We shouldn't have so much in the U.S., etc. So the path of least resistance is, for 12 years, was put money in the U.S. The path of least resistance is now, let's take it away from the U.S.
So let's talk about the Japan thing for a second, because I agree with you. The one dynamic, and look, just so it's full clear, Rupert and I have a bet over a really nice case of wine one touch, 8 versus 650 on the CNH. He's feeling a lot better about it now than he was.
He told me about this. I said, "Who can I get in on this? I'll give you wider. I'll go to 6. I'll go 8 to 6."
I think it had an 8 handle. I think it got below 6.9 today. So you guys inching in. But you know what I like to pay attention to more than dollar pegged, CNH is the CNH JPY. So you talked about Japan, and I think Japan is kind of the interesting thing right now, because if money's going to come back to Japan, that is a dynamic that is very different than my entire career, basically. So, if you think it's like that's it, you think it's gotten high enough, and that now maybe they'll start bringing them in. So you're bullish both, then, I guess is what you're saying.
So I think Japan is tough. I think China is actually super easy right now. And I think like reading the Chinese tea leaves is very easy. Reading the Japanese tea leaves is actually much, much tougher. And because you have more participants around the table, it's like, what is the BOJ going to do? What is the MOF going to do? What is Takaishi really going to do? And in Japan, very often you have the administration, the sort of the little gray man, or the blob, the blob, or what was it? The guy called in Yes, Prime Minister, Sir Humphrey. Yeah, the Sir Humphreys in Japan are really powerful, and they'll block politicians all the time. So Japan is a tough one, and that's why I personally don't have a lot invested in Japan today, because it just seems harder. But having said this, and China today seems very easy. Everything's pointing in the same direction. So China for me is by far the easier trade. That's why I'm very happy to get in on the CNH bet if you're offering it.
If I want some more action,
I'll take some of that.
Let me ask you something real quick, because obviously we all have to think about our views, and we're not always right? So what falsifies it for you? Is it capital controls? Like, how long can they maintain it? Like,
you mean in Japan?
That's
in Japan?
China.
So I think they can keep capital controls as long as they want. Now, in Japan, just to finish on Japan, what I think is going to happen in Japan isn't so much that they're going to bring the money home. The first step is stop sending money abroad. Like, before you bring the money home, you stop sending money abroad, and just with that's already an important shift. And I actually think that this has probably now started. That this is why JGBs are finding a bid, and this is why the yen is no longer going down. It's not so much that everybody's like, okay, let's bring the money home, as much as, let's at the very least, maybe Takaishi might pull a rabbit out of the hat, so maybe it's worth staying at home for a little bit.
And that's actually what happened with the Taiwan dollar, right? When the central bank stopped being on the other side, it wasn't like they're taking active action away. They just stopped the bid. And and then it just boom like that.
Boom, 10% in 3 days or whatever it was. So on China, to your point, what goes wrong? Look, I first moved to China in '94, and for me, like, bull markets in China end in one of two ways typically. Either the market goes completely nuts, and the authorities eventually say, okay, party's over. This has gone on far enough. So no more margin accounts. We raise interest rates, and they make it very visible that they're cracking down on it. Today, there's absolutely no sign of that, but that it will most likely happen at some point. But I think we're still pretty far away from that. The other way Chinese bull markets end is, people like Rupert show up and say, hey, you guys like this paper? How about a lot more of this paper? And a lot of it, and go around doing banking deals everywhere. It's like, oh, you guys like this? Here's a bunch more. And so I always say that my biggest indicator for the Chinese market is the size of your South China Morning Post that gets delivered to your office in the morning, because whenever you have banking deals that take like full page ads to announce, this placement or this rights issue, this IPO, and every bank will take a full page ad. So if you have a big IPO like a PetroChina IPO, for the sake of argument, then you have like 8 banks working on it. That's like full 8 pages of, hey, we Goldman Sachs are, we place this, and so once your South China Morning Post starts looking like a phone book, you got to start taking chips off the table. Now, we're very far from that. Now, you could tell me, oh, but last year Hong Kong had the most IPOs than any market, etc. But that was really a case of being the tallest dwarf. It's just like there were no IPOs anywhere else. It's yes, Hong Kong had IPOs, but also remember we had literally zero for 5 years. Like we had absolutely nothing for 5 years. So there was a little bit of catch up. We haven't seen any of the big IPOs yet. Is the reality? We haven't seen ByteDance. We haven't seen Alipay. So the amount of paper issued is still, not really cranked it up yet. So
for me, they're rookie numbers. They're rookie numbers.
They're rookie numbers, exactly.
And so, Louis, I wanted to bring this up in terms of, this is a slide you use a lot, using McKinsey's numbers. And can you just walk through this? Because I've heard the pitch before, but I think it's very compelling. Okay. And it also supports the view around equities and financial assets generally in China.
Yeah. So look, the problem in China is not a problem of cost of electricity or cost of energy. Today, China actually has the cheapest cost of electricity of anywhere in the world, and it's not even close. And I tend to think of economic activity as energy transformed. So my starting point is always, if you have the cheapest cost of energy, it doesn't mean you win the race, but you're definitely starting ahead. So China today, you look at it, it's got the cheapest cost of electricity. It's got by far the cheapest currency. It is so stupidly cheap in China today. You go to Shanghai, you go to Beijing, you can stay at the Four Seasons. It's going to be less than $150. US, obviously not funny money like Aussie, but proper dollars. The reality is China, they got the cheapest currency, the cheapest cost of capital. They've got the lowest interest rates in the world, the cheapest cost of energy. And I would argue that you have the cheapest cost of labor. If you're adjusted for productivity, Wei Jianshan published a piece for us a few weeks back, highlighting, he looked at productivity in 6 different industries, productivity of labor. And the best one was in the auto sector, because you can compare the Tesla Fremont factory in California to the Tesla factory in Shanghai. And the Tesla factory in Fremont, the workers cost 85 grand, plus an extra 25 grand for medical costs. The workers in Shanghai cost 15 grand. So the worker in Shanghai is cheaper than the medical cost of the worker in California. And the worker in Shanghai produces twice as many cars per worker. So you have an economy right now which has the lowest cost of electricity, lowest cost of labor, lowest cost of capital, and cheapest currency, which is why China is running trade surplus of $1.3 trillion a year, which is roughly equal to the Saudi Arabia GDP. So the place should be on fire. It should be absolutely booming. Why isn't it? It's not booming because of this chart right here. Sorry for the long intro, but essentially consumer confidence has been crushed in China. It's been crushed because of the stupid COVID policies. It's been crushed because of the real estate crackdown. It's been crushed for a whole host of reasons, and one of them being the trade war. And so now you're the Chinese leadership. You turn around, and 7 or 8 years ago, your big concern was, how do I cushion my economy against U.S. attacks? Because once the U.S. weaponized the semiconductor supply chain against you, that's what you were really, really worried about, is the U.S. essentially blocking you from other stuff, chemical products, auto parts, whatever. Fast forward 7 or 8 years, the shoe is now on the other foot. It's now the U.S. that's worried about getting embargoed from China. They're like, shit, what if China prevents us from accessing rare earths? What if China doesn't want to give us aluminum? What if China doesn't want to give us the chemical compounds to make drugs? Then we're really screwed. So China no longer has to worry about U.S. economic attacks. That's why Trump is now talking about G2 world. That's why Trump and Xi are going to meet 4 times over the next year. The days where the U.S. was trying to trip up China are now clearly over. Incidentally, that's why the U.S. is essentially turning around and saying, you know, what really matters to us is the Western Hemisphere. We're building Fortress America. We're building Fort Monroe. The rest of the world, whether it's Europe, Asia, that can go hang. We don't care. We're focusing on Fort Monroe. The real problem in China, going back to that table you were showing, is no longer how do I cushion myself against U.S. attacks. The new problem is your millennials are deeply, deeply depressed. They're not consuming. They're not getting married. They're not having kids. And so this is now the new challenge for the leadership, is how do you turn this around? How do you boost confidence? And the way you boost confidence is you throw money at the problem, which they're doing. China's going to have a deficit of 10% of GDP this year. So you throw money at the problem. You boost equities. You goose up the equity market. You revalue your currency. And you make peace with the United States in a very ostentatious way so that people feel better about the future. So all these things are unfolding. And that's why, for me, it's pretty clear that both the equities and the currency are going one way. Incidentally, that's why I'd love a piece of that bet. I'll reiterate it until you give it to me.
It's interesting, Louis.
What
2000. Go ahead.
So, Louis, what do we need to definitively say? I mean, I think the worst of the U.S.-China trade war headlines are behind us, miles behind us, in fact. I mean, what do we need to see this year out of these 4 visits? And what is the off-ramp? What does the climb down look like?
I think we've already seen the climb down, to be honest. I think the climb down was Trump talking about a G2 world. I think the climb down happened in Geneva with Besant. I think the climb down happened once the Ford CEO says, "Hey guys, in 2 weeks I'm shutting down the plants because I don't have the magnets, and without those I can't produce cars." No U.S. president, especially one that's been here for like 6 months, can be held responsible for shutting down the GM and the Ford plants, let alone the Raytheon or the Lockheed Martin plants. So the climb down is, and we've seen the climb down. It's like, okay, fine, you need those NVIDIA chips, fine, you can have them. And then she turns around and says, "Yeah, thanks, but no thanks. We've already worked the workaround. We don't need them."
Do we go as far as some kind of grand bargain, sort of BYD plants in Michigan, or do you think that's just a?
No, I think that's definitely on the agenda, and I think that's a good way to bury the or to smoke the peace pipe or bury the hatchet, because it's actually something that both want. Like Trump during the campaign actually said, "I want BYD plants in Michigan. I want Li Auto plants in Tennessee, and I want Longhorn Machinery plants in Iowa." And China's only too happy to do this. I think the U.S. deep state is not happy to do this, but Trump wants this because he wants to be there at the opening of the factory and cut the ribbon. Cut the ribbon. I did this, 10,000 jobs, etc. Yay me. So he definitely wants this, and China's very happy for that to happen. Now you could say maybe BYD doesn't want to do it because it's not going to be very profitable. But if Xi Jinping calls BYD and says, "Oh, by the way, you're opening a plant in Michigan," they'll say, "Terrific."
How many?
Terrific. We wanted to do that. Whether they wanted to or not, they'll be like, "Great."
Yeah, it's funny. The squirrel and I met over BYD. Even though I'm pushing you a little on China, I was one of the sole China bulls in 2023, early 24. It was uninvestable. This is when
it was a lonely place. It was lonely place.
You can say that
in Australia.
You can say that in just about any other company but us two. But that's we were the other lonely souls.
I'm glad we're all three together. Well, Louis, let me ask you about the other side of it, though. Europe. Yep. So Europe, they're not as excited about having BYD plants. They're letting them in. I mean, there was something that came out that said I'm a Euro bear. I mean, I understand money can go back, but maybe they're going to be protectionist. Maybe they're going to devalue. What do you think they're going to do about this situation? Or do you think they're going to put BYD plants in Munich?
I think they're already doing that, actually. I mean, there's BYD, not in Munich, because who'd be stupid enough to do it in Germany, given their energy policies, etc. But they're definitely putting them in Hungary and in Czechia and in Slovakia, in Turkey and in Poland. Poland's made it very clear, hey, we'll burn coals till the cow comes home. We just want cheap electricity. We'll mine the coal in Poland and we'll burn the coal in Poland. So if I'm putting a factory anywhere, I'm putting it either in Poland and Hungary, etc. So, what does Europe do about all of this? I tend to think that Europe can't really adopt protectionist measures. The bloc was built, the ethos of the bloc, the DNA of the bloc is fundamentally free trade. And Europe, to get compromise on anything, takes a massive crisis. It takes, for everybody to agree to do something, it needs to be really, really bad. Otherwise, the default mode in Europe is to do nothing. And And so I'm very skeptical on Europe adopting protectionism because, yeah, it's against the DNA, and they'll never all agree. Because what you'll have now that China, has really tied up countries like Hungary and Czechia and Poland into the One Belt, One Road, they've built factories there, etc. Those guys aren't going to turn on China. Now, on this, I remember this goes back like 10 years ago when Xi Jinping announced the One Belt, One Road 12 years ago. So maybe this is like 9 years ago. And I remember I was in Eastern Europe, and I met with a bunch of, there was this big conference. There were like a lot of diplomats, ambassadors there. And speaking with people from Hungary and Poland, they're all saying, you know what, China building all these railways that come all the way to us, etc. This is awesome for us because our entire history, if you're Hungary or Czechia, you've had to choose between either Germany or Russia. I mean, that's been your lot in life. You were a tiny country stuck between these two massive countries. And so essentially you were, it was obviously not right now, but most of history, it was picking between the plague and the cholera. And so having all of a sudden a third guy that comes in and says, hey, what about us? Gives you more options, and indeed allows you, like the past 50 years or 30 years, if you were Hungary, at the end of the day, you had to do what Germany told you to do because the other option was Russia, and that wasn't very palatable. So now if all of a sudden China comes along, you have an option to at least stand up to Germany a little bit. So all this to say that I think people in Eastern Europe are very happy about the One Belt, One Road, very happy. They're not going to clamor it on rooftops, but they have absolutely no interest in kicking China out because then that pushes them back into, oh, do I pick Russia? Do I pick Germany? And frankly, they don't like it.
And one final thing, what do you think of the demographic thing? That seems to be, a lot of forecasts for negative demographic growth for a while. How does that play in, or is that just too long for this time horizon that we're talking about?
Look, demographics are terrible. Pretty much, they're terrible in Europe. They're terrible in Asia. Like nobody's having babies. In Europe, we've been masking it through immigration. So it's like, oh, we pretend we have decent demographics by shipping people in, which creates its own other issues of integration, of, let's not pretend that immigration doesn't have any cost because it does. In Asia, that's obviously a non-starter for a number of reasons. I mean, first, people don't like it. Second, there's language barriers, etc. So you're having like in real time two very different models, and I think one of them, the model in Asia will turn out to be more socially probably stable, but probably a lot less growth than Europe. No, look, the bad demographics is a genuine challenge everywhere now. Is that enough of a problem to affect the market over the next year, 2 years, 3 years? I don't think so. But yeah, if you want to take a 30-year view, it's problematic. But I don't think it impacts the market over the next 72 months.
So
yeah, go ahead, Rupert.
No, you go.
No, go ahead. I was just thinking about it when you said that. It's like our mutual friend of the show, David Dredge, who I know he always talks about this shrinking demographics and why we're going to see rising taxes everywhere, and you're starting to see it. And I was just in Dubai. I do a little work over there, and a lot of people are escaping there, to escape these taxes. Do you see that as something that's a global phenomenon that's like going to change these global capital flows, as we talked about?
So look, there's many ways to deal with it. One of them is rising taxes. Another is currency debasement. Just print your way out of it. The big problem, the demographic problem, is we promised pensions to people that we can't afford. And that's, the whole welfare state was built on the premise that you had 5 workers per retiree. And today we're below two workers per retiree in most Western countries. Now, the good news is in most Asian countries, the welfare states promise no such thing. Like in China, the people are getting older and they don't expect anything out of the government, which is just as well because they're going to get nothing. So everybody's got very different dynamics.
Louis, just on that, right? The making Chinese millennials and Gen Zers happy again, right? Does force a sort of slight reversal on that front. But it's just not going to take the form of mañana money in pensions. It's going to come in the form of childcare support,
Yep.
healthcare
Oh,
support.
but that's already happening,
stuff,
right? I mean,
stuff that makes you breed, basically.
yeah. Look, they've already started. Like, China, which is funny because China's supposed to be supposedly a communist country, but there's like zero welfare state for all intents and purposes. They've now started. They said, okay, fine, free childcare from 0 to 5. So they did this like 18 months ago, and it's absolutely not moved the needle whatsoever. Now you could say, oh, it'd be even worse if they hadn't done that. But look, I think China now has a genuine, just as Japan, there's a genuine cultural problem where it's actually weird if you have more than one child. Like most people, our consumers analyst, she just had her second baby, so she was off on maternity leave. She came back. We went out for lunch in November, and she was telling me that she has an older son who's 4 years old, and out of her first son's kindergarten class, out of 25 kids, there's only one other kid with a sibling. So this is China today. So here's what I think the party does next, because they are really alarmed about it. There's rumors that the party's now going to say, look, if you want promotion, you need to have at least 2 kids. And if you have 3 or 4, then you get promotion even faster. Because they have to change the culture. Now, the party is 110 million people. Now, not all of them work in government, of course, but a lot of them work in SOEs, etc. So if you start saying, hey, if you only have 1 kid or if you have 0, your career is stalling at this level, maybe there'll be enough of an incentive for people to crank them out.
There you go. So it isn't just the Goldman Sachs partners that have to have this sort of master race number of kids. It's going to be every Chinese bureaucrat.
Like they have to do something. I think you sort of have, like, what would you do, right? It's like these.
Bold steps for big problems. I don't have a problem with it whatsoever. So staying in Asia, I mean, I haven't actually updated myself on what you think about this right now, but we've got I have to share some of your memes. Your memes get a lot of love online, but I wanted to talk about the ménage à trois meme and the role of India in this sort of new Asian dynamic. Now, as you know, I'm not a fan of Indian equities. I think I just did too much business down there over my career, and they're just painfully expensive for a value curmudgeon like me. But I'm more interested in the Xi Modi sort of new world dynamics, and whether or not that really is an opportunity for India.
So look, I think I'm sure you know Lord Palmerston's famous dictum that nations have no permanent friends and no permanent enemies, just permanent interests. Now, I think if you look at, let's start off with Russia. If Russia for 200 years, their business model was extracting stuff out of the ground and selling it to Europe. Now, for obvious reason, that business model no longer works. So now Russia is now extracting stuff out of the ground and selling it to China. But that leaves them in a situation where they only have one client. And you know the old story, if you only have one client, you don't have a client, you have a boss. So if you're Putin, being 100% dependent on China is really not that great. Now you could say, tough for him. He put himself in that situation, but he's desperately trying to get out of that situation. And so that's his predicament. Now, the obvious market for Putin is India. India needs a lot of commodities. Historically, 70-year friendship between Russia and India. It's the obvious market for him. The challenge is to get the commodities there. You got to go through the oceans. And as we're seeing, the U.S. is increasingly saying, hey, look, on commodity deals, if we don't like either the buyer or the seller, we reserve the right to intervene. So that's a problem. The obvious solution is build infrastructure to move the commodities from Russia to India through China. Of course, China says, okay, maybe, why not? But what's in it for me, right? So that brings you then to India. So India, the permanent interest of India is indeed to get cheap commodities. India has always been a commodity scarce country. They used to starve. They used to not have enough food. They definitely don't have enough energy. They have tremendous infrastructure rollout needs. So they need all those commodities that Russia provides. How do they get them there? How do they get them there at the right price? Even better, can they pay for them in their own currency? Now, the problem of India, you've done business there a long time. It's always running current account deficits because it's such a commodity importer. So that's going back to the permanent interests. You're running these big current account deficits. How did you make up for them? By and large, you exported smart people. You exported smart people to Europe. You exported smart people to the US, to Australia, to Canada, and these people sent money home. That's how you made up the numbers. And this is the other thing you did to earn foreign dollars, to earn US dollars, was you did IT services and call centers. Two businesses, like if there's two businesses that are going to be destroyed by AI, it's those two. So like if I'm Modi today, I'm thinking, okay, all my US dollar revenue generators are being destroyed in front of my eyes. The call centers gone, the IT services gone, and my ability to export guys to Australia, to Canada, etc., is under big threat because there's a big pushback. People are like, okay, you know what? We like even Canada, which has always been perhaps the most welcoming of countries. I spent a lot of time here. The most welcoming of countries is like, you know what? We have enough immigrants for now. Like we can revisit in 5 years. But Carney came in. The Liberal Party said, you know what? Let's put a more like freeze. Like let's just digest all the stuff all the guys we already took in. So now you're Modi, you're thinking, okay, how do I get the commodity? How am I going to get to pay for the commodities that I need? And then you get to China. China's business model for 40, 50 years was essentially I produce cheap stuff and I sell it mostly to America. That obviously died. China's business model has evolved. I now sell high value added goods. I sell infrastructure projects, etc. And I sell them mostly into emerging markets. And obviously the single biggest market is India. So all of a sudden you can see how the puzzle pieces have rearranged, where now if you get those three guys together in a room, like that picture showed, you could say, okay, you know what? You've got the cheap commodities. You've got the cheapest labor. I have the ability to build cheap infrastructure, and tell you what, I can fund it at the cheapest cost of capital. You put all this together in a pot, you mix it around, and that actually makes for a pretty potent brew. And so I'm not saying this is going to happen, but the Tianjin meeting of September definitely opened up the door to this. And this is how today Modi, Xi, Putin are talking. And if you are mixing, what is essentially on a purchasing parity adjusted basis, the second or first biggest economy in the world, with the fourth and the seventh biggest economies in the world, and all of a sudden you start having more free flow of capital, more free flow of goods, more free flow of labor, you're going to have an epic economic boom. So once again, I'm not saying this is going to happen, but the door is open to it happening. So it needs to be monitored. And if it does happen, then I would say the financial markets are absolutely not ready for what's going to be unleashed. You look at the top 30 market caps in the world, and you essentially have 3 or 4 companies that get to participate in that boom, and 26 that absolutely do not get to participate in that boom. So if you think, you know what, AI is going to be the biggest thing of the next 10 years, then you're fine buying the S&P 500, you're fine buying the world MSCI, you've got the right companies, etc. But if you think actually what the single most important thing that's going to happen is what Putin, Xi, and Modi told us was going to happen when they met in September back in Tianjin, that actually we should take them at their word, and that there's going to be actions that follow on these promises, then the markets aren't ready for it. Now, since that meeting, every commodity market has ripped higher. Since that meeting, bond yields in all those countries have come down. Since that meeting, currencies in those countries have gone up. It's like the markets, like the politicians are telling you, those 3 politicians are telling you we're heading over there, and the markets are increasingly telling you, yep, you know what, that is what's happening.
I think that's absolutely spot on.
So there's one commodity that has not really participated, and that's energy. And Louis, I got to tell you, I still remember the macro voices when you were on with Eric, and we went negative. And as a guy who had $10 puts that day, it made me very happy. But what do you think's going on with energy?
This is just energy relative to the S&P, by the way. That's the monthly chart.
So
okay.
So I think it is actually starting to move. If you look at year to date, energy is the best performing sector. My take on energy is pretty simple. The market perception is, of course, that we have all this excess supply, that we have all this excess oil, that we have all this excess natural gas, etc. And I tend to believe that this belief is going to get tested. It's going to get tested for a number of reasons, not least of which the fact that everything that's happened in the past 6 months should lead to everyone who needs energy along the supply chain to build more inventories.
Yeah, exactly. We've moved from just in time to just in case.
That's
right?
that's my big line. Yeah. No.
It's oh shit, did I steal that from you? I don't know.
No, it's okay. It's fine. Maybe I stole it from you.
Sincerest form of flattery in that case.
I think we really have. Look, I'm sorry, I'm monopolizing the conversation, but actually this might be the most important point I make today. We've lived for 70 or 80 years in a financial system in which everybody saved in U.S. Treasuries because it was a liquid market. And whenever there was a risk, you could always transform your U.S. Treasuries into something else. You could transform it into, if you needed oil, you transform it into oil, or if you needed food, or if there was a tsunami or an earthquake or whatever, you could always shift your U.S. Treasuries. Now, so we lived in a world, the backbone of our global financial architecture was Treasuries equals commodities at a moment's notice. Now, what's happened is in 22, when we seized the Russian assets, we said, look, you get access to your Treasuries if you're not a total jerk. You get access to your Treasuries if we say you do. So that moved a lot of people to say, you know what, I'm not that comfortable with it, so I'm going to buy gold instead. So all the central banks of China, of Saudi Arabia, of Qatar, Bahrain, etc., they all started buying gold. So that was the first step. With the Maduro removal, what was surprising to me was not only did they remove Maduro, to be honest, I was expecting that, was the rhetoric that came out of the White House in the wake of the removal. They came out and said, you know what, we get to decide where Venezuela oil goes from now on. We get to seize ships if we don't like it. We get to say, if there's somebody who's either buying oil or selling oil and it's moving on the ocean, we reserve the right to seize those ships. I mean, that was the rhetoric coming out of Rubio. That was the rhetoric coming out of Pete Hegseth, of J.D. Vance. They all came out with the same message. It was coordinated. It was, we control the commodity markets. Now, I think they reacted that way as a pushback against China controlling the rare earths, because they had just been bitch slapped on rare earths. I'm sorry, this is really not PG-13, but because they'd just been bitch slapped on rare earths, they turned around and said, hey, you know what? You want to play that game? We can play that game on energy. Now, with this, plus all the uncertainties around Iran, the stories of regime change in Iran, etc., if that message, if I'm Xi Jinping, but also if I'm Modi, also if I'm Erdogan in Turkey, like anybody who has aspirations to run a foreign policy different from the United States. Hell, if I'm the prime minister of Denmark, I'm probably thinking, I'm importing oil every day. Do I want to keep all my reserves in treasuries? Tomorrow, Trump could say, hey, I'm seizing your treasuries and you don't get to import oil until you give me Denmark. Like, I know it sounds stupid and crazy, but does it? Like, all of a sudden, you don't know where the limit lies. So all this to say that in this equation, treasuries equals commodities. 3 years ago or 4 years ago, we came for the treasuries. And now, 4 years later, the U.S. is coming for the commodities, saying, hey, you get access to commodities if we say you do. So this means that everybody's got to build up commodity inventories. And if that happens, I think that's so initially people just did gold because that's easy to store. I think the next step, everybody's going to do oil, because if you're China, maybe you stocked up on gold, and if you can't ship in oil, what good does that do you? Right? It's like, I'm not going to burn the gold. I'm not going to eat the gold. So I think we're moving into an environment where everybody will want to stockpile food and stockpile oil.
Yeah, I mean,
does that mean the ag complex finally gets a bid? Do you think that means that the ag complex finally gets a bid?
So that one, I'm less sure. I'm less sure. Now, maybe, like 6 times bitten, like more shy or whatever. The problem, I think, with the ag complex, what I struggle with the ag complex is I think people underestimate the extent to which China is helping countries all around Africa, Asia, Central Asia, etc., modernize their agricultural production on the cheap and on credit. Like, all of a sudden, you go to places like Zimbabwe or Kenya or wherever, and all of a sudden you've got like Chinese tractors everywhere. So the productivity in a lot of these countries is actually going through the roof. In Kazakhstan, or in the Kazakhstan, where they used to use like old Soviet tractors that were all sorts of crappy. Now all of a sudden you get brand new Chinese tractors, brand new Chinese combines. So for me, that's the big overhang on farming, is that I actually think that the production could continue increasing in a way that in energy, like nobody's making any investments in energy, because the investments in energy are much more expensive. Like an oil rig is tens, if not hundreds of millions of dollars, and and nobody yet, nobody's going to trust a Chinese oil rig because the liability is just too high. But are you going to buy a $50,000 Chinese tractor? Sure, especially if you're given a credit at 3%, which is what's happening everywhere around the world. So that's my one fear of around the ag complex.
And I agree with you. By the way, on the energy thing, it's like, my view is that energy is primary money, and then you have dollars or whatever fiat is claim on energy. So maybe you guys are just skipping it. They're like, hey, I'm going to get gold as stored energy, oil. So I agree with you on that. And as we go forward now and think about this world that's changing, I mean, what other than, okay, commodities are bid, what are the other major implications that you see that are like the big level, like 3-year, 5-year? Because when you look back at 2011, I remember how cheap America was and how expensive Japan was. And that was the only test you needed. And it was, or Australia, where Rupert is expensive. So what are the obvious, like, 10-year takeaways right now for the global markets, other than the ones we talk about?
Gavekal happens to have a slide on that.
Yeah.
Great. References.
Good work, Rupert.
Yeah, no. So look, I do think, for me, again, like the obvious trade today is Chinese equities. China feels so much like the U.S. did back in 2010. 2010, everybody was going around saying, "Oh my God, it's a lost decade. We're gonna have low single digits forever. It's a new normal. It's a new paradigm, etc." And of course, U.S. equities ended up delivering their best 15 years. And part of the reason the U.S. did so well was because there was no inflation in the U.S. post the 2008 bust. The Fed could do QE1, QE2, QE3. The Fed could do QE infinity. And it was pushing all this money in, and the money wasn't feeding economic growth, and it wasn't feeding real estate. It was all going into equities. And we forget this, but U.S. GDP growth was actually really lackluster from 2010 to about 2017, 2018. That's why Trump got elected in the first place. People were talking about a profitless recovery and a jobless recovery and a K-shaped economy even back then. It was like the stock market was doing well, but you go back, you look at GDP, it was like 1%, 1.5%. It was pretty lame stuff. And it's so what China's going through today. China today, you pick up your FT front page, like, disappointing growth in China today. Therefore, they're doing more stimulus, budget deficit of 10% of GDP, money supply, like narrow money supply is growing at 3 times the rate of nominal GDP. They're pushing money in, and the money that in the past would have gone into real estate or in the past would have gone into feeding GDP growth, it goes into equity markets. So you pick up your FT and it's like, growth is disappointing on page 1, and page 2, Hank saying, another update, 8 shares, another update. And so it grinds higher. And that's not the only comparison. 2010, US had the cheapest cost of energy. Today, China has the cheapest cost of energy. 2010, the US dollar was super cheap. Today, the renminbi is super cheap. 2010, US had the lowest cost of capital. Today, China has the lowest cost of capital. So that to me is the obvious trade. Now, having said that, above all, the big trade for me is the US dollar is going down. And once you start off with that, you can express that in so many different ways. You can express it through commodity markets. You can express it through outperformance of EM. And within EM, and Rupert and I have talked about this in the past, but for me, the slam dunk trade today is Latin America. Like, I know for a lot of people, China is toxic, it's uninvestable, it's evil, they eat children for breakfast, etc. Actually, they've stopped eating children for breakfast. They don't have enough of them. They're too expensive now, too rare. Same story. It's like, they use child labor in the factories. It's like, no, they don't. They don't have enough of them.
It's robots.
It's robot, exactly. No, look, jokes aside, the slam dunk trade in EM for me is LATAM. I mean, now that the U.S. has said we're refocusing on the Western Hemisphere, and we're essentially going to backstop everyone to make sure that they don't go bust and go hoard themselves out to China like they did with Argentina. Argentina is going to go bust. Here's 20 billion. Here's 40 billion. You've removed the single biggest risk for Latin American countries, which is that these guys every 10 to 15 years manage to run out of dollars and hit the wall. You remove that risk, bond yields can go down 200 basis points a year for the next 3 years. And you had the first year last year, they went down 200 basis points. They're down another 200 basis, going to go down another 200 basis points this year, and another 200 basis points the year after that. And that is such a tailwind for equity markets, for real estate, for consumption. So bottom line, lots and lots of ways to express the weaker dollar trade.
So Louis, when Gavekal LATAM local currency fixed income ETF?
No, we have one.
Yeah, you've got UCITS. I thought you were going to do an ETF.
Oh, ETF. Sorry, ETF.
Yeah.
Here's the. Sorry, apologies. No, we have the UCITS one. An ETF, running an ETF on debt, on equities, you can do whatever the hell you want. The SEC is so funny. On equities, like if I wanted to do a 3-time levered ETF on Nvidia, have at it. Go have fun. If I want to do a 3-time levered ETF on Bitcoin, sure, why not? But if I want to do an ETF that has Brazilian debt and Colombian debt and Chilean debt, then I can't have any single issuer be more than 10% of the underlying. Yeah. So if you want to do a pan Latin American, it's very challenging. It's extremely challenging because you need essentially 14, 15 different issues. Right, yeah. Because you need to be under 10% on all of them.
How do you get there with corporate borrowers?
So you can get there with corporate borrowers, but look, when you do an ETF, you need liquidity. Is the reality. Now, how many genuine and by the way, and running an ETF, the costs are decently high. So you're only going to make proper money if it's going to be $500, $600, $700 million. So once you reach those levels, there's a lot of bond issues. So for example, in our UCITS fund today, we own a bunch of Paraguay, which has been a terrific trade for us. We've owned a bunch of Uruguay, which has been a great trade for us. You can't do that. You can't do that on a $500 million fund. You actually can't. These markets are too small. You can't trade $5 million a day on those guys. And when you run a UCITS fund and you know your end investors and you're like, okay, I feel decently comfortable that they're not about to redeem me, etc. But on an ETF, you don't know. It goes up and down every day. So all this to say that I would love to launch a Brazil debt ETF because I think that would absolutely crush it. And I have clients all the time who ask me, but the between the SEC regulations, between the liquidity of the underlying, the reality is you're asking to essentially put yourself in a very challenging position, either legally or in terms of managing clients' expectations. You're going to create problems for yourself.
Time for a return of closed-end funds. Closed-end funds could be making a comeback. You never know.
No, that's one way to do it, or you do it through a mutual fund, or if listeners who are big enough can do it themselves. You can go out and buy Brazilian government debt or Chilean government debt, and it involves doing a little more work, but a little work has never killed anybody.
And real estate. I was down in Medellin over the New Year's, and Rupert and I was blown away how nice that town is. And one of my mates who in London was down there, macro manager. So I agree with you. I think the LATAM thing is real. And the real estate is probably the most interesting thing, to be honest. Now, I know not everyone wants to go down there and buy, but that seemed because when you're talking about lower rates, and they don't even really have a mortgage market yet either. At some point, they'll get a mortgage market.
Absolutely. I'll leave aside the choice of word between Medellin and blown away. I'll leave aside because that can be interpreted in so many different directions.
Thank you for calling me out.
But that can go that could go side. So I'll leave the choice of words aside. No, look, Colombia is actually a very interesting because you have the election coming up this spring, the presidential election, and it's actually the latest polls is 50-50 essentially. It really is a coin toss, and Petro, who can't run again, is doing everything he can to get the left wing to come in. So as they say in Spanish, he's very much eating tomorrow's bread today. Running deficits, issuing all the debt at the short end of the curve to keep rates low, etc.
Like all emerging markets.
Yeah, but he's doing it in size. So if Colombia is actually, perhaps of all of them, for me, is perhaps today one of the more dangerous markets, actually, because if the right comes in, they're going to initially load the bus and say, oh, Petro, he did all these mistakes, etc. So they might start off with a little bit of austerity, which the market won't like. And if the left gets elected, the market won't like it either. So I'm a little reluctant on Colombia. Meanwhile, Chile and Peru have everything going for them today. They're obviously huge metal exporters. Colombia is more of an energy exporter, and not just and I mean oil, not the white powder kind of energy. The copper, the silver that Peru, that Chile export, etc. So they've got huge tailwinds. They've got governments that are very credible, that are also, if ever there's problems, Trump will backstop those guys while he's been fighting with Colombia. So to me, the easiest trend right now is it's Chile, it's Peru, and it's Argentina. These are the sort of easy trades. And then you have the elephant in the room, which is Brazil and the election coming up this fall.
Listen. My view on this one is that Brazil works when commodities are working. So if you believe commodities are working, the result of that election barely matters, right?
I agree with that, and you can make the same case for Colombia. In fairness, like if oil prices go to $75, Colombia is going to rip. I mean, it's just that simple.
That's what I was going to say. I mean, the peso's been very strong despite Petro, despite oil being on its ass here for a while. So those things could change, and that's part of the bullishness. But I hear you on the austerity.
For sure.
So the only thing, and I'm a LATAM bull, right? It's a big position for me. But the only thing that bothers me is if you decompose the returns around the emerging markets between multiple expansion, genuine EPS growth, and then the currency kicker. Basically, everything in LATAM in the last sort of 6 to 12 months has come from multiple expansion.
Yeah, because I've been falling interest rates.
Yeah,
it's been the counterback. Interest rates fall, multiples expand. Right? It's almost.
But actually, if you look at South Africa, for example, right? Yeah. It's all earnings contribution, right? It is. I think multiples actually contracted.
No, I think that's very fair. And South Africa has been, it's been a super, super impressive bull market. I was last in South Africa 15 months ago, and I wrote a piece at the time over it where I was like, oh, for the first time, people aren't slashing their wrists. Like whenever you went to South Africa, people are like, oh my God, it's so terrible. Which is understandable when your electricity is getting cut and you don't have running water. It does put a dampener on the mood. But look, South Africa looks and feels a lot better. But to your point, I think what's fascinating to me about emerging markets, whether LATAM, whether South Africa, whether Korea, you've had all these bull markets that have each had their own drivers. In Latin America, it's the falling interest rates. In South Africa, it's the rising commodities, and especially the precious metals, and the fact that they now have electricity and water. In Korea, it's obviously been the AI boom and the semiconductor aspect, but it's also been I think the change in taxation that has encouraged people to bring money home. In Taiwan, it's been now, and in China, we discussed the driver of the boom. All this leaves you with a simple reality, is that for 10, 12 years, EMs kept getting outflows. Emerging markets, money kept going into emerging markets. And within that sinking ship of falling emerging markets, the rearrangement of deck chairs within the falling ship always favored India, because India was the one good story. You had political scandals in Brazil. China was uninvestable because it was about to invade Taiwan.
And India was bullish because it was the next China.
And it was the next China. And in fairness, you also had a lot of local buying, which you still do. But it was like, oh, yeah, I'll just participate with the locals. Obviously, Russia was uninvestable. So there were lots and lots. So now all of a sudden, what you're seeing, and all the big capital allocators, and I've had this conversation with 3 different CIOs of really big capital allocators, big pension funds, guys who 2 or 3 years ago were telling me China is uninvestable and essentially liquidated their China more or less at the bottom, are now turning around and saying, "Oh, I'm so bullish EM. We're going to massively increase our allocation to EM." Now, the first reason they're doing this is because the EM index is 50% China. So it allows them to buy back China without saying, "I messed up 2 years ago when I liquidated at the bottom." It's like, "Oh yeah, I'm bullish EM. Oh, nice coincidence. It's half the index is China." But they'll say, "Oh, I'm massively bullish EM. Look at what's happening in Latam. Look at what's happening in South Africa. Look what's happening in Korea. Oh, China, yeah, I hadn't noticed. Sure, why not?" And so the reality is we have yet to see the EM allocations come through the pipe. And you can talk to any EM manager out there, whether debt, whether equity. The EM allocations are just now beginning. You mentioned, so we manage a LATAM debt fund. Up until 3 months ago, so we had a monster year last year. We were up 35%, happy days. But it was last year, up at the start of this year, we were 120 million in AUM. Now, 6 weeks into the year, we're now 250 million in AUM. Now you could say, okay, that's tiny money. It's 120 million, etc. But for 4 years, nobody would listen to you, and now we've got money all of a sudden coming in from people we don't even know. So the EM allocations,
you don't even have to fill out RFPs these days. You just happen to be in the business. Yeah.
Well, exactly. It's like there's nobody left. There's like go look for LATAM debt, local currency debt funds. I think we're like 1 of 2. So if that's what you want, it's either us or them. So the bottom line is where the fund flows haven't even really begun. They're just starting, and they're starting.
And there's not much cap, right? Like it's just there's only 10 or 13 trillion of cap, right? I mean, it's not like it takes that much money to move these things.
So okay, that's a great point, because foreigners have never owned more than the U.S. market than they own today. So roughly 19% of the U.S. equity market is now owned by foreigners, which is the highest it's been. Now, let's imagine that foreigners decide, I'm going to take 1% out of my 19. I'm going to move back down to 18. That essentially corresponds to $700 billion US dollars. And then I'm going to allocate it around the world, pari passu. I'm taking that and I'm like splitting it between, and I'm weighing it on Europe. So Europe gets a third, Japan gets like 15%, China gets 15%. If you put whatever percentage it is, I can't remember what it is, into Latin American equities, it's 14 days of volume. It's 14 days of volume.
Exactly. So that's what I'm saying.
It doesn't take a lot of
junior miners. They're like junior miners, you put a little money in uranium mine and it goes vertical.
Exactly. So I think these things can absolutely go on a stick.
Love it. Confirmation bias restored. Louis Gave. What a way. It's Friday morning already here in Melbourne. What a way to end the week. I think we'll wrap things up there. I've just noticed we're almost at an hour and 10 minutes with it. It's always a treat talking to you, Louis, my friend. Thank you so much for joining us on Benny and the Squirrel. Benny, anything you want to add?
No, it's great to catch up. Let me know when you're back in Hong Kong. And
I am up there in April. I'll catch you then, and I will.
Surprisingly, at the sevens. Surprisingly, just when the sevens are there, there's a shocker.
It actually coincides with something else. But I will put how to find Louis Gave, as if people that follow us didn't know already. I will put all of that in the show notes. Thank you again, my friend. You better get back out on the ski slopes, I think.
No, it's 5 p.m. over here in Whistler. Great to
all right,
you guys.
Well, Benny and the Squirrel out. Thank you so much.
Thanks so much, guys.
And